Hey everyone, so my investment strategy, the way that I approach looking at individual businesses has really not changed at all over the past few years. I very much follow Warren Buffett's key investing principles that I have learned mostly through reading his Berkshire Hathaway shareholder letters and also taking lessons from some of the real investments that he's made over the past couple of decades. But recently I've had a growing interest in one particular modern value investor, and that is Nick Sleep. And while I will probably remain a Buffett disciple until the day that I die, Nick Sleep's specific application of Buffett principles brings a modern perspective to many quotes and lessons that we have heard over and over from Warren. And in today's video, I want to talk about Nick Sleep's application of intrinsic value, how to figure out what is an appropriate price to pay for a stock. And towards the end, I'm also going to be sharing an example using Nick Sleep's method in my free spreadsheet resource, which you can download a free copy of and follow along in today's video if you want. The link to that will be probably the first link down in the description below. Nick Sleep ran an investment fund from 2001 to 2014 with his investment partner Gaz Zakaria, called the Nomad Fund. The fund generated an annualized return of 20.8% per year before fees, which was 18.4% after fees, and that was a massive improvement if you compare it to something like the MSCI World Index, which generated a 6.5% return during that period. And over that 13-year period, there was a couple of different types of value investing that was being used by these investors. Early on in the fund, they had a much more diversified portfolio and they were looking for mostly small, deep value businesses. And then towards the end of the fund, they had a much more concentrated Charlie Munger style portfolio with actually only 3 positions when they ended the fund. And similar to Munger and Buffett's Berkshire Hathaway, Nick Sleep took the opportunity every 6 months to write a detailed shareholder letter explaining his investment approach as well as his specific thesis on companies that they had purchased. So as a value investor or anyone who is trying to mimic Warren Buffett's key investing principles, there is a ton of value in these letters. Even though they're not written by Charlie Munger or Warren Buffett, Nick Sleep is one of the people who have done a really good job at applying those principles and adding a modern twist to them, adding his own twist to them, and he goes into a ton of detail in those letters, so there's a lot to learn. And in today's video, we're not going to talk about everything because there are a lot of letters there, but I just wanted to zoom in on his explanation of how he approaches intrinsic valuation. But first, let's make sure we all understand what Warren Buffett has said about intrinsic value and how you should be thinking about calculating the price to pay for a stock. According to Warren Buffett, intrinsic value is the total amount of cash that a business returns to us over its remaining life, discounted at an appropriate rate. To put it even more simply, what profit does the business produce that it reinvests in the business and therefore drives a higher value for the business, a higher stock price for the business, as well as the cash that from profits is delivered directly to us, either in the form of share repurchases, which again will make your piece of ownership larger and therefore worth more, or cash dividends paid directly to you. So the sum of all of those cash flows is what you get back from an investment. And there's actually a mathematical formula for what Buffett is describing, and it's called the present value of discounted cash flows. Now, this formula may look a little bit complicated, but it's really not that crazy. It takes cash flow produced by the business in each of the next 5 or 10 years, depending on what approach you have. We'll talk a little bit more about that when we talk about Nick Sleep's approach. And then you want to discount those cash flows back to the present day at a specified rate. And then we want to add what's called a terminal value at the end, and that terminal value reflects all of the cash produced by the business after the 10th or 5th year, depending on what period you're modeling over, essentially allowing us to come up with an estimate of the total amount of cash produced by the business over its remaining life. Now, today's video isn't about going into the details of that specific formula and how to apply it. I do have a video or a couple of videos on intrinsic value going through that. I'll leave a couple of them linked down in the description below if you want to check those out later. I do think it is important to understand how the formula works and what you're doing when you're doing this, but in terms of how you actually go about calculating intrinsic value, I'm not using these raw formulas and a calculator. I'm using my free spreadsheet resource, which does all of the maths for you. So while I do think it is important that you understand what you're doing so that you're not just sticking numbers in blindly, once you do understand what you're doing, you're not going to be using that formula in its raw form on a day-to-day basis. You're going to use something like my free spreadsheet resource, which allows you to do it extremely easily. And when using this formula in my spreadsheet, you can see that we have to start with a cash flow or a profit figure that was produced usually in the previous year. So you've got a starting point for what their cash flows are or were in the previous year. We then want to estimate how fast that profit figure will grow over the next 5 or 10 years. And then we need to decide what we're going to discount it back at. And this is where things get a little bit muddly. What return should we be targeting? Should we be targeting a 5% return, a 10% return, 20, 30%, 100%? What rate should we be using? And this is something that Buffett actually doesn't talk about. He doesn't talk about what specific rate he's using, or even if he is using a specific rate. And this is where we can turn to someone like Nick Sleep, who goes into great detail about how he is applying the principle that Buffett has provided to us, which is that we should be estimating cash flows and then discounting them back. But he also gives the details of how he's actually going about doing that. And in particular, he talks about what discount rate is appropriate in order to get to achieving results like he has, where he generated a 20 or 21% return per year over a 13-year period. So let's jump over to one of the Nomad letters and see what Nick Sleep says specifically on how to approach this component. He says, "Our aim is to make investments at prices we consider to be 50 cents on the dollar of what a typical firm is worth." So in this first part, of course, what Nick Sleep is describing is using a margin of safety. So it's not just good enough to calculate what we think the intrinsic value of a business is. We then need to pay a substantial discount to that price. We might want to take, well, Nick Sleep takes 50% off what he thinks intrinsic value is and is only willing to pay $50 cents on the dollar, and that allows for errors in our valuation as well as the randomness that is the business world and economics, that there are going to be things that happen that mean that businesses will have variance around what profit they produce in the future. Capital allocation by investee companies must be consistent with value creation, and if this is the case, then we expect real value of businesses, the 100 cents value, to grow at about 10% per annum. So what Nick Sleep actually says here is a couple of things. One is that he is using a discount rate of 10%, and then that calculates intrinsic value, and then he takes 50% off that for his margin of safety, so that he's paying 50 cents on the dollar. But the other thing he says is really interesting, which is, why does he use the 10% rate? And the reason why he uses a 10% rate is fairly logical. You can think about a business or investing in a business as investing in a compounding machine. You're investing in a business or a management team, let's say, that has access to cash, profit that's coming in, and they're going to reinvest that profit and grow it into more profit, right? And if we're looking for really good compounders, we're probably going to be looking for businesses that can produce at least a 10% return on invested capital. So for the profit that they produce and that they reinvest, they can generate at least 10% on that profit. And if a business was producing a 10% return on invested capital and reinvesting all of the profit that came in, then they would be growing their profits at about 10% per year. So that is what we should expect out of businesses, or demand out of businesses, in terms of the return on investment over the very long term. The effect over 5 years will be to compound $1 of value into $1.62, and companies that can build value like this are normally rewarded in the market with a fair valuation. For example, a price close to $1.62. So again, he's explaining a couple of things here. One is he's explaining what would happen if a company compounded at 10% per year, and that would mean that they're able to turn $1 into $1.62. And the other thing he says, which I think is really, really important, is that the types of businesses that compound like that are more likely to be recognized by the market and have fair or even premium valuations. And this is important because markets are often irrational. So even though there might be a business might be crappy, but on a cash basis, on a deep value basis, it might look like a good investment. The market may never realize that value. It may never give it a fair valuation. So sticking to businesses that are really good compounders and that are really good capital allocators means that you have a far more likely chance that the business or the stock price is going to reflect the true value of the business. This happy outcome would imply a return from purchase price, which remember is 50 cents because we're paying 50 cents on a dollar, of around 26% per annum over that 5-year period. And this is really critical to understand, right? If he was buying these businesses at fair value and discounting them at 10% and buying them at their intrinsic value, then if he is right, he's going to make a 10% return, right? And if he's wrong, he's going to make a return that's far below that, right? But because he's paying 50 cents on the dollar, because he's paying far below what these businesses are worth, if he's right with his initial assessment of the growth of profits in the future, he's actually going to make a 26% per year return over that 5-year period. And he goes on to say that if he is wrong in half of his investments, which for the types of businesses he's looking at, wrong means that maybe the stock just doesn't go up, but it's unlikely to lose money. If that is the case for even half of the investments that he makes and half of them are right, overall the portfolio will make a return of around 13% per year, which is still substantially above what the average market is likely to achieve. So now I just want to jump over to my computer and show you an example, a really quick example with my free spreadsheet resource. Currently, my spreadsheet doesn't do a 5-year discounting period. That's something that I'm actually going to be adding in a new update to the spreadsheet that's coming out in a couple of weeks. So just hold on for a second and that will be coming out shortly. But I'm going to show you an example with the 10-year period that I personally use, and you can get pretty much the same outcome in terms of the valuation that you're getting.
All right, so now over on my spreadsheet, as I mentioned, you can download a free copy of this and follow along. It'll be the first link in the description below. The first thing you'll need to do if you are using this part of the spreadsheet is you want to head over to the data input tab and make sure you have the ticker symbol entered in here. So for example purposes, today we're going to be looking at ASOS. This is a company that I recently made a small investment into, although this is not advice on the intrinsic value of that business specifically. This, of course, is just an example. But I've entered the ticker symbol in there, London Stock Exchange with the colon and then the ticker symbol. Then, of course, as I mentioned earlier, you need to have a starting cash or profit figure here. I'm using the 5-year average for ASOS because their profits have been quite volatile over the past few years, so particularly around the pandemic. So I'm using a 5-year average as the starting position here. I then have my growth estimates of how I think the business will grow over the next 10 years. Nick Sleep uses a 5-year period, so he's using a shorter table here. You can see that I'm projecting cash flow for each of the next 10 years. He's projecting only for the next 5 years and therefore using probably higher growth rates to reflect the fact that the businesses that we're looking at will probably grow at a higher rate over the next 5 years than, say, over the next 10 years. I'm then using a terminal growth rate of 3%. So that basically means that for my terminal value calculation at the end, I'm assuming that after the 10th year, like let's just assume we're using model 1. So I use a range of models here. So we get a range of intrinsic value, but assuming we're looking at model 1 here, I'm expecting 11% per year growth for the first 10 years. And then after the 10th year, they will assume that terminal growth rate, which is a 3% rate. Then we select our discount rate or required rate of return. As we just spoke about, Nick Sleep uses a 10% rate, so we're going to be using that today. I personally use a 15% rate before accounting for that margin of safety, and that gives us some outcomes. We have the buy price for the whole business, so before considering the per share value of the stock. By the way, all of these are in dollars, but they should be in British pounds. I just haven't changed the currency in the spreadsheet. But you can see that gives us a buy price for the whole business. So that's somewhere between 2.5 billion to 6.1 billion pounds. It then calculates it on a per share basis. On a per share basis, that's $26 to $62 per share. Something that isn't in the spreadsheet right now, but will be in a couple of weeks, is taking into account cash and debt. So you want to be adding the net cash position for the business to the buy price. In ASOS's case, they have $6.24 of cash, $4 of debt per share, and that gives us net cash of 1.91 pounds. So we could add that to each of these, meaning the true intrinsic value would be somewhere between $28 and $62 per share. And then, of course, on top of that, we need to account for a margin of safety. So again, I'm going to be making some adaptations to the spreadsheet because actually going through Nick Sleep's letters has made me realize that the way that I set up this spreadsheet originally, it works, but it's not the simplest way that it could be set up. So I'm going to be making some adjustments so that it's a little bit easier to look at. But we would need to take another 50% off this, meaning my true buy range per se for where I would be happy to invest in the company, assuming these growth rates are accurate, which is, this is just an example, that true buy range would be somewhere between $14 per share and about $31 per share using Nick Sleep's required rate of return or discount rate of 10%.
The last thing that I wanted to talk about in today's video is contrasting my approach to intrinsic value and Nick Sleep's approach. We both use the discounted cash flow. The really only difference, of course, there will be differences in what we think about companies growing in the future, but the real big difference, I think, is in the discount rate, what we're trying to target, right? Nick Sleep is targeting 10% per year over a 5-year period and then adding a 50% margin of safety. For me personally, most of the time, I'm targeting a 15% return over a 10-year period and then also adding that 50% margin of safety on top. So when we include that 50% margin of safety, again, as we spoke about earlier with Nick Sleep, he targets 10% without a 50% margin of safety. And when you add that 50% margin of safety over a 5-year period, that means he's targeting 26% per year. Because I'm targeting 15% plus a margin of safety, I'm actually targeting 32%. So I'm much more conservative. And then the same is true over a 10-year period. He ends up targeting about 18% per year over a 10-year period, while I'm targeting about 23% per year. So does that mean that I'm too conservative and that I should be using a 10% and a 50% margin of safety instead of 15% and a 50% margin of safety? Well, I personally don't think I've been too conservative. I've been able to find enough deals to build my portfolio and generate about a 31% per year return over the past 5 years, which is pretty much in line with what I'm targeting. So I target 15% plus a 50% margin of safety, and over a 5-year period, that would mean a 32% per year return. So that basically means I've been pretty accurate in my projections, even with that margin of safety. So I'm pretty comfortable with what I'm doing right now, but I do really respect Nick Sleep, and I'll never say never that Nick Sleep may or may not have an influence in how I shape the application of these key Warren Buffett investing principles. As I mentioned, I'm going to be releasing a new version of the spreadsheet in a couple of weeks, so you can look forward to that. It'll make it a lot easier, even from where it is now. I think it's a pretty good spreadsheet for approaching intrinsic value through Buffett's principles, but I'm going to be adding a ton of new features that make it even easier to approach it, particularly for people who are just getting started. So that'll be coming out in a couple of weeks, but feel free to download the copy of the spreadsheet that is available now, again, linked down in the description below. So I hope you guys got some value out of today's video. And if you did, I would very much appreciate it if you hit that subscribe button and stay around for more content that I post in the future. I had this light on way too bright today. That's why I'm kind of squinting. I think I've probably done some damage to my eye over the past 20 minutes while recording this. But with that said, I'd love to hear your thoughts down in the comment section below. And I hope you guys have a great day. I'll see you in the next video. Oh my God, I'm blind.